the defensive sectors are starting to, in your mind, should be getting some more attention right now.
Yeah.
How should investors be thinking about those sectors or the exposure, the relative weighting of them in someone's portfolio as we head into this earnings season, as we head into kind of like the back half of the year? How are things positioned in your mind, and what exactly does it look like in terms of how this earnings season is going to shape up?
The bar is so low for some of these defensive
Has
companies.
it really been managed that low to where it's not going to take that much?
It's basement bottom pickings right here, right? So energy, you just had an event in the Middle East, you can't even get oil above 70, 75 bucks. So energy is just kind of left for dead. I do think healthcare is very interesting in that there's been a mass exodus of outflows from healthcare sector ETFs, and healthcare's performance versus the S&P is in its bottom decile over the last 50 years. So it's really bad out there, however, for healthcare. Folks are scared of the administration, I get that. But I wonder if you can start to nibble in certain areas. Maybe it's equipment, maybe it's some pharma right there. So we'll see if they can surprise in the upside for earnings, and that would be a boost for healthcare sector ETFs. And then staples, to me, is just not built for this generation outside of Costco and Walmart, right? Nobody wants to eat the types of cereals and whatnot, as tasty as they are, from those traditional companies. And so I guess overall, you have to think differently about your defensive exposure because they just do not have the same clout as they normally would within the S&P 500.
Bob, from a CIO's perspective, from a hedge fund CIO's perspective, now from an ETF CIO's perspective, what exactly has you thinking about where the opportunities are in this kind of market? It's all correct, everything you've been saying. It has been very headline driven. It's very macro oriented in focus. How exactly does one navigate through that kind of a market? And where exactly are you seeing some of those opportunities as they kind of percolate through this news cycle?
Yeah, I mean, I think it really comes down to going global and going long and short. And the reality is, if you look at most investors, they are long only, and they're mostly focused on U.S. assets. And that leaves a lot of opportunity out there for those who are willing to hire managers and look for returns that are, outside of the traditional 60-40. So, a simple example is there's great alpha to be generated in the exchange rate markets that very few investors have as part of their portfolio. Hedge funds have done a very good job benefiting from the falling dollar positioning. Or the opportunity to maybe fade some trades or some consensus thinking. So if you look at global macro managers as an example, they're actually starting to build long bond positions as yields have risen in recent weeks. That's a very non-consensus trade. It's a trade that actually paid off a month or two ago when they built those positions. And it's a trade that's building today. And so that sort of flexibility, long, short, being able to flexibly respond to the policy environment as it evolves, I think is really important in terms of building a portfolio and getting away from the long only, mega cap tech stock mindset and get to something that's flexible that can navigate through this sort of environment.
When you, as an ETF manager, look at the dynamism that you just referred to, how quickly or frequently are you adjusting the portfolio within your funds? I mean, so let's say we pay you the 95 bips to manage our money as ETF customers. What exactly is your strategy with regard to how often you trade or turn things over or make portfolio adjustments?
Yeah, I mean, we're looking at managers' performance and market action on a daily basis and adjusting our positioning based upon how we're seeing managers shift their positions. In normal times, if you're managing a substantial portfolio, you're probably trading over weeks and months because you don't want to incur undue transactions costs. But in times like these, where policy is moving quickly and where market action is moving quickly, you can see managers shift positions from long to short over the course of weeks. It's the sort of thing that if you're sitting in the shoes of, say, an advisor trying to build a portfolio, you don't have the time to be able to navigate through policy as it goes from secularly high tariffs to pause back to secularly high tariffs, as a simple example. And so that's one of the great things about the ETF wrapper is you can bring in strategies that can essentially do that for you as part of a strategic allocation in your portfolio.
Now, Todd, you look at fund flows quite often. What exactly are the flows telling you right now about how things are shaping up for the second half of this year?
So we're about 3 months off the S&P 500 low back in April 8th. The leading category, I like to dig a little level deeper here, has been crypto. Investors are just latching onto this move.
And by the way, we're speaking timely because this is going to go into an archive somewhere. But as of today, we hit $123,000 plus on Bitcoin prices. So that's a big deal.
Oh yeah, yeah. I think there is this kind of opening up of the gap of allowing crypto into model allocations or portfolios beyond just the pure speculative nature for it. I think investors are realizing it's an asset that's here to stay. You're also seeing plenty of money go to cash. You still get 4.25% in a money market fund or similar type of short duration ETF. So crypto and cash are popular. And then on the outflow list, you have folks hating small caps. Small cap outflows, despite the massive rally off the low. Perhaps an interesting contrarian play there. The small caps haven't worked in ages, but it's tough to beat mega cap growth with them.
All right. And as we conclude this, because we could go on forever, I'm going to ask each of you the same question. Your favorite part of the market right now, where you think is the one that's ripest with the most opportunity, whether it's in the stock market in certain specific names or sectors, or whether it's international on the macro side of things, dollar, euro, yen, whatever it is. What's your favorite spot in the market for the next 6 months?
Well, I think building portfolios that can do well in a falling growth environment. So you're talking about positions long bonds, long gold, and short the US dollar. Those are all positions that, for those who are sort of all in on, the US growth story, that's a very non-consensus view that is also favored by some of the smartest financial minds in the world in the hedge fund community.
All right, now same question to
Long
you.
bonds is very interesting to me. I'm going to go with the momentum from Bitcoin, though, that area. I think that it's going to become consensus very quick, but a lot of lift there.
Do you think there's a catch-up trade for Ethereum?
Why not?
Okay.
Even though I couldn't tell you the difference, and the viewers, the difference between the two of them, but that also seems to be coming into play as well. And the Ethereum funds are taking in money, too.